Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and due diligence. Plus, every Sunday, I put out our weekly MicroCap wrap to show how the MicroCap space has performed every week and compared to the broader markets based on data from the MicroCap Review Index. Again, to subscribe, go to microcapnewsletter.substack.com. Quite a bit of content that we actually have put out there from Planet MicroCap. We just published the Q2 2022 issue of the MicroCap Review, which you will also be able to get access to on MicroCap newsletter.substack.com, as well as at microcapreview.com, and also the direct link through Scribd, as well as we're going to be reconstituting the index very, very shortly as well for Q3 2022. So be sure to subscribe to that Substack. That's where you're going to get all the updates on everything. So again, that's microcapnewsletter.substack.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Sharon Wang. She's the Senior Investment Analyst at PenderFund. We originally met when Sharon moderated a panel titled MicroCap Technology Growth Companies at our virtual event in December 2021, which I highly recommend checking out that panel. And I wanted to get to know Sharon and her investing philosophy a bit better. Assuming that you've been following the news, or better yet, seen the performance from the MicroCap Review Index, the broader markets have been taking a bit of a shellacking, with MicroCaps taking the brunt of this beatdown. With all this in mind, the best investors see market drawdowns as a chance to find and or add to quality positions. That's what Sharon and I discussed today, what she looks for and her small and microcap criteria during market drawdowns. Thank you again for tuning into episode 232 of the Planet MicroCap Podcast, and please enjoy my conversation with Sharon Wang. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And joining me right now is someone who actually hosted an amazing panel at our most recent virtual event back in December. I highly recommend going to check that out. And I wanted to have her on for a one-on-one interview because I want to understand a little bit more about her background and her investing style and all that good stuff. So With that, I'd like to introduce Sharon Wang. She is the Senior Investment Analyst at PenderFund. Sharon, thank you for joining me today. How are you doing?
Good, thank you. Thank you for having me here.
It's great to have you on. During that panel, we didn't get a chance to get into your background or anything like that. So can you start us off with where your passion for investing began and how you got to where you're at today?
Sure. I wish I could tell you a inspiring story of how I started buying my first stock when I was 12. The reality is no. I didn't know what stock was at age of 12. I was born and raised in China. No idea of what a stock exchange looks like. No idea of Wall Street or Main Street. At that time, the concept of investing was still very foreign. Not like today, because before COVID, I went to the AGM of Berkshire Hathaway, and I saw like a couple of young kids from China asking questions to Warren and Charlie in fluent English. And I was like, wow, they know what they want to do in the future. But at my time, I didn't know. So my only goal at the time when I was a teenager was I have to study hard and get into one of the top universities in China so I could have a bright future. So I did that and I got really high marks at the national entrance exam. I got into one of the top universities. And I still don't know what I wanted to do. So after I graduated from university, I tried a couple of different things, like journalism, and then figured out that was not really my thing. And then I decided to give finance a try because one of my friends, she really loved it and she always talking about it. So I'm like, okay, I'm going to try it. And that actually opened the door and I did find my path there and I started to love it. So I got into the Master of Science program in finance. I just loved it. I wanted to know more about it and set my heart on the investment career. So I guess part of the thing is my personality because I'm naturally a very curious person. And this whole idea of investing, looking at different companies, talking to different people, management team, and know what they do and why they do what they do and what works and what does not work. This whole, reading, digging, researching really excite me and make me feel good. So that's how I actually landed in this investment land. And I guess the whole point is, you don't really necessarily need to figure out what you want to do at a very early stage, maybe not at 12, not at 20, maybe. But once you figure it out, it's never too late to pursue your passion.
Sharon, you give yourself a little credit. Okay, that was a very inspiring story, and how you got to where you are. Okay, that was fantastic, and I can only hope that everyone is doing something that they're as passionate about as you are, right? And so as I said in the intro, you're now at PenderFund. You joined the team, I think, in 2013. So how did this all come about?
Yeah, it's actually a very long story. So David Barr, the CEO and portfolio manager at Pender and also my partner, he gave my first job in investment when I first moved to Vancouver in 2007. At the time, I was fresh out of school, no experience. I didn't know anybody, no connection, and LinkedIn and those, platform virtually not really very common, right? So what I did is I Googled asset managers in Vancouver and found a few names and I sent resumes to them. And to make my cover letter look more interesting, I actually borrowed one of the statements from a local commercial saying bold makes it happen. I guess they really liked that, so I got an interview, and we liked each other. And at the time, PenderFund was not a mutual fund business, so Dave actually started the mutual fund business back in 2009. That was 2007. He was managing a venture capital fund at the time, and it was like pretty small, like a tiny, and they only had a temporary analyst position. But I was happy to get into the door and learn. And Dave has been a wonderful mentor for me. So I went there for a few months before the term expired, and they didn't have a full-time position because the fund itself was trying to figure out where it's going to be, right? So I found another job at a local sell-side brokerage firm as a research associate. So I worked there for 5 years. And so Dave, at the same time, I kept in touch with Dave, and he started his the mutual fund business in 2009, and in 2013 the fund started to scale, and he really need an analyst because he doesn't have an analyst, just himself. So he reached out to me, and I was thrilled to have this opportunity because I feel it's time for me to have a change. And on the buy side, you probably are going to get exposures to a broader sectors and companies, not as sell side, you only focus on one sector most of the time. So I feel like that's a great opportunity, and I really love to work with Dave again. So that's when I joined. And 9 years later, I'm still here, and I'm looking forward to many more years to come.
Absolutely. Dave is the best. We've had him on the pod, and he also moderated a panel at our recent show too. Yeah. And so Dave's great. And I'm really happy that, you guys found each other in this and able to grow PenderFund to what it is today. Right. So catch us up now. So you joined 2013, it's now 2022. What specifically, what aspect of the fund are you working on? I believe you're on the small cap MicroCap side, if I'm correct.
So PenderFund actually is we manage multiple asset classes. We have public equity, fixed income, alternatives, and also private equity. So I am mostly working on the public equity side and helping Dave managing the small cap opportunities fund, which has been existing since 2009 and had a pretty good track record. So and knock on wood, let's keep going. But we are a very collaborative organization, and there's a lot of discussions between teams, and so we can share each other investment ideas and helping actually companies to grow from private companies to public and all that. So it's a very wholesome and comprehensive picture over there.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter, and that's Quartr. Now back to the show. Well, talk to me a little bit, on small cap opportunity side here. I mean, we're doing this interview on what's today, Tuesday, June 14th. Literally the news just came out yesterday that we are now officially in a recession. Mm-hmm. I mean, this is kind of one of those times when a lot of microcap and small cap investors where we're kind of licking our chops saying, all right, time to dig in and find some stuff, because on the news side, I mean, we're seeing, there's a lot of companies reporting quality earnings, on this microcap, small cap side, and it's just literally falling on deaf ears, right? Like nobody cares, which is, in my opinion, potentially an opportunity for folks to kind of dig a little deeper. So, I mean, what are you seeing on your end?
Yeah, exactly. Actually, we're quite excited about today's market because, as you just mentioned, you see the fundamental of business are still growing and progressing, but the market doesn't really give any credit, and they even discount growth, especially non-profitable, not profitable growth, to like negative value almost. I've been seeing companies trading like with consistent growth, like 40%, and trading like at less than 1.5 times EV revenue, which is basically, and from my experience, I've never seen that level. But I think this is, so that actually provides us a lot of opportunities and get us excited because we understand how small cap works. And if you look at history, I'm not saying history repeats itself, but it does rhyme, right? So if you look at history, small cap actually tend to outperform whenever like leading out of the recession. Like if you look at the 12 months or 24 months performance after a market drawdown, small cap has pretty good performance. And the reason, I guess one of the reasons could be because small cap is quite, companies are very adaptive, and they actually manage crisis sometimes better than their large peers. And especially in today's environment, because of all the hype of inflation, right? All the unexpected inflationary environment. So in this type of environment, a company, like what do companies do to survive, right? So they need to be really adaptable on their cost structure, and they really need to have the pricing power and competitive modes so that they could keep the revenue growing. So on the top line, you need to keep your growth. On the bottom line, you have to be able to control your cost. And for established companies, sometimes it's really hard to do. It's really hard to turn a big ship around. So I feel like a lot of software, especially in the software space, right? Because your costs are most variable costs, not really fixed cost. So you could probably adjust that quickly. And small cap has the natural advantage of doing that. And small cap tends to trade like historically on average, it should be at a premium to large cap because of risk levels, right? So now they're actually trading at a pretty big valuation gap below the large caps. So if you think about the mean to reversion, the multiple re-rating, plus the growth of the underlying business, that's quite a dramatic growth trajectory there. And so I think for companies that have can adapt them, and the management team with an adaptable and capable management team that can steer through this crisis with a healthy balance sheet for sure. And because the cost of capital definitely goes up, if you don't have a healthy balance sheet, you probably deteriorate pretty fast. I think those type of business actually are going to weather through the stock market and generate pretty good return for us. And that's where actually we look for.
Absolutely. I mean, I would assume it during this time also you're speaking with management teams quite often, just because there's all, you could see on, through all the statements and press releases, what they might be doing to manage some of the costs and kind of steer through what's going on right now. But now is where management is by far most important, because when you're seeing some of these macro pressures, recession pressures, inflation, that's where you want to understand from them, okay, what is your plan? So, I mean, have you just been talking with management nonstop just to kind of see how they're doing it? What are some of the things that they're telling you?
So we do talk to management constantly, quite regularly, and not just because of this downturn. That's our part of our investment process. And some of them are very transparent. I actually really like the transparency of some of them, right? Because they're not just telling me as a shareholder what they're going to do, but they're actually talking about their plans on the conference calls, so every shareholders or everybody who's interested in their company can know what their plan is, right? So, for example, one of the software company, local Vancouver software companies we have in the portfolio, they actually announced a layoff of 20% of their employees in Q1 because they feel like their cost structure are not really the optimized. But the way they did it is very inspiring, I feel, because they are very transparent about it. They told everybody about it, and then they actually listed all the names of the laid off employees on their website and trying to help them to land the next job. So this type of transparency and support of the company does demonstrate the culture they have. So I think culture is very important in small cap companies because you're so small, and especially the culture from the top people from the management does have a lot of influence on everybody within that company. So that's one of the examples. And the other examples is just this morning we had a company reported, and they showed a little bit of growth slowdown, but they were very clear of their steps, like what they're going to do to address this, right? They're going to actually move one of their sales, like top managers, to one of the regions where they see the slowing growth to accelerate the growth there, and at the same time they're trying to optimize cost structures and put price increases in one of their for their hardware and their services, because they have never raised the prices while their competitors have raised prices in the last couple of years already. So they laid out the plans, and that gave investors a bit more confidence, right? Because at least they know what they want to do.
So in your opinion, as we're looking at this, seeing the macro outlook, but even before this, we all saw, our index, that's kind of the main data point that I look at, it's down over 15% year to date. So we've been seeing that microcaps, small caps have been getting hit, and this was all coming. But for you, I mean, you mentioned a couple things already, but when you're looking at some of the companies in the portfolio, or just even potentially new names, what are some of the things that you're kind of hoping to see from these management teams, from these companies, that make it either interesting to them put more money in, or even some red flags? You're like, what, maybe we'll exit this position for now and redeploy this capital to something else.
Yeah, actually, last year in Canada, there was a boom of IPOs, right? And tech IPOs. I mean, in the tech sector, we never seen that so many tech IPOs in 1 year. Actually, I think there's some reports saying the total number of tech IPOs in last year is more than the total number of IPOs in the last 9 to 12 years in Canada. That was crazy, right? So we as a good, people know us in the small cap tech space in Canada. So typically we would be invited into their pre-roadshow meetings, test water meetings, and then their IPO roadshow meetings, and then invite us to be investors. But at the time, when we look at the business and the valuation, and some of the companies, we really like their business, but we don't like the valuation, so we didn't actually jump right in. But then things suddenly changed. Everything is bad. It's like, no, people don't give any credit to growth. So all these IPOs had, their price dropped. Some of them dropped like 80-90%. So when we look at these companies and we're trying to see, okay, does anything fundamentally change? Have their unit economics changed? Like their cost of customer acquisitions changed? Or is there still technology still help the world doing things better and cheaper? Is this something that really can work in the long time, or only transitory, only during COVID? So we try to assess, a lot of assessments are quite qualitative and not really quantitative, not really from numbers. And then we talk with investors, we talk with a management team, we talk with their customers, and we try to get all the information we can. And then we realize, we come to a conclusion that some of these businesses are still great business, and they have a lot of cash on the balance sheet that could actually help them through this time period, or even they can even grow because they have this dry powder on the balance sheet. They can go on and acquire somebody, right? So, but a lot of a lot of them are still growing very nicely organically, but they do have the dry powder there, and you can see a path to profitability in a few years. So it's not like you don't see a path to profitability at all. It's you could actually see a visible path. You can see how things can improve and scale up, and then you can reach a point of cash flow break even. So for those type of companies, and of course the management team, right? We, like I said, I really like the management that are capable, adaptable, and transparent. So they, when we talk with them, we get an idea of what they do, and that gave us confidence. We actually bought a number of IPO names from last year, just because we still think they have a pretty good business, and the valuation now is in the range that we can't resist.
Absolutely. So, to take a quick step back, for those that don't know, PenderFund is based in you mentioned this earlier, but you guys are based in Vancouver, and you focus specifically on Canadian, on the tech side, or basically everything non-resource, right? If I'm It's
everything we invest, basically non-resource names, but our focus, we're generalist, but with a focus on tech space. that's just because our own background, because Dave started when he did the venture capital is in the tech space, and he personally loves technology, and the same with me. When I worked at the sell side, I was a research associate for the tech analyst, and then we just love the space because for myself personally, when I see something that can help the world to do things better and 10 times better and cheaper, and that's really attractive, like that lures me into know more about the business. So
gotcha. So I talking a little bit more about looking at kind of the macro, and I think it's needless to say that Canadian tech IPOs might be just a little down in 2022, especially compared to 2021. Yeah. But I remember seeing a chart that a colleague of mine, I think he posted on Twitter, or he might have sent it to me, but basically talking about how just looking at liquidity right now, and there's just it's more or less dried up in some of the on the TSX venture. I mean, are you seeing some of the same things? And how do you think about what this might mean when you're looking ahead and looking at potential new ideas or even portfolio companies?
I think liquidity is important for us because our fund, although we are long-term investors, but it's the actual investors that provide us the capital. We don't really have the permanent capital. And so the thing we try to do is to really educate our investors that this is actually a good time to buy, not to sell, not to redeem, right? So that way we could have at least the liquidity on our side to invest on these companies. And I think because we are tech investors and we have a pretty good relationship with these companies, and we do believe we have the confidence that they can do well. So in this kind of liquidity crunch time, it's actually good if we actually have the capital to support them. That actually shows we actually have confidence in those type of business. We are trying to support them. So and I think holding the companies for long term, that could generate very attractive returns.
So another question I have for you, you mentioned that, a generalist, but kind of more of a tech bias.
Yeah.
A little tech bias. What are some of the within tech that you've seen that's been interesting in the last, year and change that you think in the long term might have a bit more of some runway, some moats? I'd love to hear your answer there.
So I'm not so good with general discussions, trends and all that, but because I'm more like bottom up, type of approach. So from what I see is there's I really like the enterprise software space because that's where you see a lot of innovation, and the customer base is stickier and it's a little bit it's not as finicky as the consumer space, right? The B2C space. The B2B space is very interesting, and you see a lot of slow changing sectors are actually making some changes. For example, one of the portfolio companies we have is called Copperleaf Technologies. What they do is they actually help provide a data-driven analytic software for utilities or other asset planning decision makers to make their investment decisions better. So it's if you look at those utilities companies, they sometimes do things like a very old-fashioned. They do things on Excel spreadsheets, but they are dealing with billions of dollars, like multi-million of dollars of investment decisions, right? So you don't really want things to go wrong. So actually, Copperleaf provide a software that gathers data, provide analytics, and give them the tool for them to make better investment decisions. I think that actually, and you see utilities sector actually start to adopt this, and not just utility sector, they actually make inroads into like the water sector in the UK, those water utilities as well, and then there are other type of sectors that they can go in. So you kind of see this gradual change, and especially now when inflation is high, labor costs, material costs are all very high, and you're dealing with supply chain issues. So you actually, as a decision maker, you probably are going to rely on data, on software to make your process a little bit better, a little bit more efficient, right? This is actually the time for them to digitize things. So we kind of see the trend of going that way. And the other company we invested in our portfolio is Kinaxis, which is supply chain planning software. I think probably many people have heard of them, and they are providing like a concurrent supply chain planning software, and they are quite unique and advanced in that way compared to the incumbent of the SAP, those type of ERP software.
Got it. Yeah. Look, the reason I asked is because I wanted to, show that, we weren't just all looking at fintech, right?
No, it's not just fintech. No.
Because I mean, obviously, like that has been, the kind of been front and center on the technology side for the last, since I think March 2020, right?
Yeah.
So that's not to say there aren't interesting ideas in the fintech space, but there's other stuff
there's
too.
A lot of going on in the payment industry, and we had a few other holdings that in that space, but yeah.
Gotcha. So, I mean, for you, what investing experience, especially since you've joined PenderFund in 2013, what would you say is an investing experience that really taught you the most and was like, oh, this is small cap. All right, we're in it now. I'd love to hear an experience there.
It's a very good question, and it's a hard one to answer because I actually I don't think I had any experience that really changed like my career or anything, but I do have things that mistakes, and sometimes mistakes that make me to reshape my thinking. And I actually, the famous investor Charlie Munger always, I really like the quote from him, any year that passes in which you don't destroy one of your best loved ideas is a wasted year. So that's very well said. And so so when I first fresh out of school, at school you learn a lot of modeling, a lot of numbers, how to interpret financial statements and all that. So I screwed a little bit more on modeling. Like I really try to make my forecast as accurate as it could be, but I know it's precisely wrong most of the time. And then I started gradually to realize that the numbers are important, and understanding financial statements are important. But what's more important is you actually understand what's the story behind those numbers. Like how do you interpret the numbers? What assumptions, for all the assumptions, you need to understand it and make sense out of it. You need to have your own story of this investment, so that makes sense. So I would rather be considered a business analyst than a financial analyst. So when you look at a company, it's better to look at it from the business quality perspective. It's more qualitative than the quantitative approach. I think that changed my thinking. So gradually I built up my own way of evaluating a company. And the other mistakes I learned from is, I think it's an important lesson for myself, is you're trying to hold on to compounders a bit longer and trying to sell, to say bye to the close of discount stories quicker. So you probably are not familiar, for people who are not familiar with the terms compounders and close discount, I'll just explain it a bit better here, because that's how we at Pender categorized the type of business, the different types of business. So the compounders are business that can compound their intrinsic value in the mid-teen or better, and they have a really solid business fundamental of a mode that can last them for a pretty long time. And for those type of business, our philosophy is to buy low and let grow. So don't touch them. And for the close discount stories are typically it's an okay business, but at really cheap price. and maybe there's some catalyst coming to close the discount. You do see that there's a gap between the price and the value, and there's a apparent catalyst to close that discount. And for those type of business, it's like buy low and sell high. Like you just want to it's more like a trade type of opportunity for us. So when we look at these two different type of businesses, for compounders, we tend to, at least myself, being on the conservative side, I tend to underestimate the bull case scenarios. Sometimes it actually runs through my bull case, and I'm like, oh, it's too expensive, we should sell it. But these good business actually surprise you on the upside. They just continue going on, and they have, especially when they have some, free optionalities that where they try different things and one thing actually work, and that's like big. So that's become the main revenue driver, which you probably would never seen it previously. You never would expect that could happen. And that's just the magic of the compounding. So you should probably, for myself, I think I should hold on to it. Don't be too cheap. Don't okay, it's already runs through bull case scenario, and then we should sell it. So on the other end of the spectrum, the closer discount stories sometimes also surprise us, but on the negative side. So they actually, the things deteriorate a lot faster than you expect. But you're like, oh, how bad it could be. It's already pretty bad. How worse? but then you realize, okay, there's actually no, you don't see any catalyst coming. You don't know when this can be, the discount would be closed. You just keep dragging the revenue decline and all that. So there's no point of keep holding on to it. The longer you hold on to it, the more opportunity costs are, the return will be diminishing as well with time, right? So, that's something I learned, but I think I still need to improve on those things because sometimes it's hard to tell when to buy or when to sell.
Especially right now, right? I mean, that's an incredible lesson to have to bring into what's going on right now. I mean, in your recent Q1 letter that you just put out, it's, you've mentioned that the opportunities were focused on finding higher quality businesses and kind of letting not even necessarily the losers, but just, the lower quality business models go. And that still takes so much discipline because, there was a reason that you got into that you invested in that business to begin with. You thought, okay, this might be on the higher quality, this might work, so that's incredibly difficult. People maybe sometimes don't maybe take that a little bit for granted.
Yeah, it's actually we're doing right now. We're kind of upgrading the quality of our whole portfolio. Trying to get rid of the slow grinding names, but trying to figure out getting into the more quality names. So that way we could have a portfolio that we probably don't really need to touch that often and still grow pretty nicely for our shareholders, for our unit holders.
Do you have any fear of it getting too concentrated during times like these?
No, because we actually still hold a good 50 names, and I
was gonna say you guys have a lot of holdings, but I figure I'd ask. Why not? I mean, if I have to ask, of the lower quality, now I'm not going to ask you to name names, obviously, but I mean, what are some of the characteristics of quote unquote the lower quality that you're kind of maybe we'll revisit this in different times? Yeah,
sure. I think at a time like this, the first thing to evaluate is probably the balance sheet risks, because you really want to avoid catastrophic risk, right? So bankruptcy and if this company has too high leverage and they're still bleeding, they don't make any cash, and this bleeding cash, and they don't have a lot of money on the balance sheet, and if you see they don't have a good growth trajectory. So for those type of business, you do want to get rid of them, right? So because what we're trying to do is trying to mitigate downside risks for the whole portfolio as well. And the other, not necessarily relates to today's environment, but in general, I think some of the red flags or yellow flags you look for a business quality deterioration is, you look at the growth, right? If you if you look at the growth, they kind of declining, and they're still spending a lot though in sales and marketing or in research. Then that means either their product, probably people don't really like it, right? So there's no good product market fit. So although they spend a lot of money, you still don't see the growth. And the other things you might want to look is the margin profile, like gross margin. If you see declining gross margin, I would think that's a bad sign, because that either means the costs are too high. You don't have the pricing power to transfer the cost to your consumers, or you're because of competition, and you have to lower your price, so squeeze your margin, right? So that's not a good thing either way, right? So those are some of the warning signs you wanna see. And if you see management suddenly change their tones, right? They probably used to give a lot of KPIs, and suddenly they don't disclose that, and they don't have anything to replace those. They will say, okay, we don't think these are appropriate things for us to disclose, but they don't give you other KPIs to replace these ones. So that means they probably have something bad to hide. But there's subtle things.
Yeah, no, that's a pretty quality list. So, I mean, in times like these, I mean, how much more weight do you give to margin shrinkage, I guess you say, margin shrinkage versus, let's say, quarter over quarter, revenue going down, right? Like how much weight do you give to either one in times like these?
I think it really depends, what's the situation is, right? Sometimes the revenue growth, if you see the growth coming down or slowing down, it may not be a problem. It may be because in the last few years, like, we see companies going through the SaaS transition. So they have the on-premise software where they want to transition it to SaaS, and then during that transition, you actually see the growth coming down because they're trying to transit, right? So if in that type of situation, actually the growth slowing down is not necessarily a bad thing. It just happens that way. But then you can see like a tick up later on once they complete the transition. Actually, that could be a good buying opportunity because the market view those as bad things, while they actually have a legit reason for it, right? So, but for margin compression, it's a little bit more, I think for myself, I took that more seriously, and I would really want to dig into why the margin actually declined. And sometimes it's because the data cost more, right? But then that doesn't really make sense, because when you have bigger scale, your public cloud, those type of costs actually should come down a little bit. But some companies, they actually have a usage related cost structure. So they actually they charge the same subscription price to their customers, but their usage as part of the cost structure would come up because customer use more of their platform. It's a good thing, but then on the cost side, you have to pay more for your data usage to the public cloud providers like Amazon and all this, right? So it's really depends on the situation. It's not a one size fit all answer.
Gotcha.
I'm afraid.
No, I'm more just thinking about this is why I'm not on CNBC. Margin shrinkage, versus margin compression. You should be on there. But I think we've covered quite a bit today. I mean, is there anything that we're missing that you feel that our investor audience should know? Going through these times and understanding how to maybe look at their portfolios, especially if they're in microcaps. What is any final words of wisdom or advice that folks should really, when they're thinking about their portfolios and maybe even looking at potential investments right now?
Sure, I think this is probably a time where you can find your ideal investment. So when I say ideal investment, that means, an investment that you can buy now and just leave it in your coffee can portfolio. You don't need to touch it. You never lose sleep. And many years later, you've done pretty good. It's a pretty good return generated by this type of names. So the quality of business is something you really want to spend a lot of time on, and it's pretty hard to make a prediction that these type of businesses are going to flourish for the next 20 years, right? So, but you have to try, right? And I think on this course, and you always remember there's a difference between price and value. You want to pay a price, the price you pay should be lower than the value of the company. So the price and the value are two different things. Don't mix them together. And then you have to think about risk. Whenever you talk about returns, the risk is always there. You have to think about, risks, like what type of risks are associated with this, and is this at an acceptable level for you? It's not you're not, because you don't want to lose sleep on this, right, on your investment. For any new investors, or any people that really loved to do the investing themselves, or want to learn more about investing, I think the reading, like read, and that's one of the top things I would recommend. We actually have a book recommendation blog on our website where you can get a lot of really good book names that if you really want to explore. And along the way you will make a lot of mistakes, and don't be afraid. I think investing is a very humbling experience. Especially during the market downturns like this, right? I remember back in March 2020, many things happened and took a turn at the time when you least expected. You just don't know, and so don't just stay open-minded, be adaptable, don't be afraid to make mistakes. Just learn from it, and hopefully you don't make it twice. But we are all humans. We are probably have a tendency to make the same mistake twice. But at least you should be cognizant of your own weakness, and trying to find your strengths, trying to find an edge. And that's where you can generate a better than market returns, is where you have an edge, whether it's analytical or whether it's behavioral, right? If you're more patient than other people, you probably could ride it out the tough times and make a good return. So just don't be afraid.
Very good. Well, Sharon, with that, where can our audience go and find more information about you, follow you and your insights, as well as PenderFund?
You can find me at under the team profile at PenderFund.com, and I'm typically really good with emails, but we do have a lot of emails coming through our inbox. But if you have any questions, feel free to reach out. Yeah.
Very good. Well, Sharon, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thank you. Thank you for having me. Have a great day.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.